While some online bullion dealers continue to charge $4 over spot for US Mint Silver Eagles, SD Bullion is selling 2016 Silver Eagles for just $2.29 over spot for any quantity. Again, that's just $2.29 over spot for any quantity. If you haven't joined over 25,000 new customers by making the switch to SD Bullion, what are you waiting for? You could save hundreds or even thousands of dollars on your next order. SD Bullion, the lowest prices, period.
This is the Doc and Eric Dubin with the SD Weekly Metals and Markets Wrap. Joining us today, what is it, the day after all the bank stress tests released here. We have all kinds of chaos in the markets all week after Brexit last Friday. We have our good friend James Turk out of London from goldmoney.com. James, it's great to have you back on the show.
Great to be with you guys.
Well, James, what's your take here on the market? We're just about 1 week past Brexit and your vote to leave the euro. There's been a lot of hype made about it. There's been a lot of scaremongering that the world's going to end because Britain wants to be independent again. So let's start out with your take on that and then its effect on the markets here, James.
First of all, looking at the impact on the UK, I think it's going to be a great thing for the UK. They're getting rid of all of the bureaucratic hassle. UK is in a strong negotiating position because it has a trade deficit with the European Union. So, I mean, if the European Union tries to be tough in negotiating the exit, they'll be shooting themselves in the foot, and particularly the German car manufacturers, which the UK is a major market. So I think it's all going to work out, but it's going to take a period of time, probably close to that 2-year period that they're talking about. In the meantime, the UK remains part of the EU and life goes on as before, which is part of the reason that the stock market, the FTSE, is back to the levels it was before the Brexit vote. I think what happened is there was so much scaremongering in the papers about what would happen if the EU, if the UK decided to leave the EU, that there was a lot of selling after the vote because it just people weren't expecting it. But now, cooler heads are prevailing and they're recognizing that, hey, what's changed? Effectively nothing, although it will change longer term.
What do you think about the domestic politics? I mean, that's going to definitely be something that is a moving target. And, you being in London and spending a lot of time in the European Union overall, what do you make as far as how that's going to shake out? Because it seems like that's going to be a prime source for a lot of uncertainty, and that'll possibly upset markets on a going forward basis.
Yeah, the United Kingdom is 4 nations. It's England, Wales, Northern Ireland, and Scotland. Scotland and most of Northern Ireland, voted against leaving. They wanted to remain. And so they're arguing that they should, at least Scotland is arguing that they should have another referendum on becoming an independent sovereign nation. And that may or may not happen. But I think the bottom line is that all of these political events can continue to operate in the background, but we shouldn't allow that to take our eye off the ball, which is, of course, what's happening in the monetary sphere, what central banks are doing to destroy national currencies. And I think perhaps most importantly, what's happening to banks around the world. All you have to do is look at the shares of bank stocks, or the share prices of bank stocks, and you'll see that there's a real problem there. Stocks like Deutsche Bank, they're trading at 25%. The market cap is 25% of their book value. So obviously people are looking at the banks and saying, boy, there are going to be a lot of losses yet to come in the banking system. And when you talk about losses in the banking system, with everything interconnected these days globally, you're talking about another 2008 type of event. So the question is, who's going to be the layman this time around? And there are a lot of potential targets out there.
Well, that's an interesting question that a lot of people speculate about. Deutsche Bank, in fact, being layman, take 2.0. I'd love to get your sense as to whether or not you think it's possible or indeed probable that the authorities are in the process of ring-fencing Deutsche Bank and planning to actually just nationalize, make it like a good bank, bad bank division for assets, nationalize the punk assets, and address Deutsche Bank that way. Today it was announced that the IMF said that, looking at the exact quote here, among the GSIBS, globally systemic important banks, Deutsche Bank appears to be the most important net contributor to systemic risks, followed by HSBC and Credit Suisse. And, the markets have been aware of Deutsche Bank's problems for 18 some odd months now, and it reminds me a lot of the way Bear Stearns, after the Alt-A subprime segment of the market blew up and their maiden lane hedge funds blew up in 2007, and then there was a long period where it just was like a walking dead bank, and then finally taken out in February of 2008. Do you think that kind of experience, and then the experience of seeing Lehman Brothers take down the financial system in a derivatives crash and systemic, contagion risk spread, is something that the central bankers are sufficiently scared out of their minds to want to take a Deutsche Bank and privatize the good assets, nationalize the bad assets and create a new creature of some sort? I'm wondering if you think that that's a possible scenario that's given a lot of weight behind the scenes, because I am frankly skeptical of looking at Lehman Brothers as a black swan, and I know that that's particularly fashionable. Even in Zero Hedge's reporting this morning, that's the way they're characterizing Deutsche Bank. And I'd just love your take on those hypotheses that I have.
Yeah, there's no doubt in my mind that the central bankers are trying to circle the wagons one way or another. They're doing it with Deutsche Bank, I'm sure, although there's been nothing public from which I'm aware. There have been a number of public announcements about the Italian banking system, which in the aggregate is as bad as Deutsche Bank is by itself. And there's just an announcement today that the Italian government is thinking about putting another $5 billion of money into this bad bank system that they're trying to set up. But here's the bottom line. The bottom line is that there are a lot of bad assets in the banking system that are never going to be repaid. And that means their losses are going to be taken. And there are only two ways that those losses can be taken. Either the taxpayers take the loss and bail out the bank, or the depositors of the bank take the loss and they bail in the bank, which is something that we saw in Cyprus and also in Greece. So it's one of those two options, and they're neither one of them are good. So basically what the bottom line is that you want to minimize your exposure to the banking system and maximize your exposure to precious metals, because they don't have counterparty risk. When you own physical gold or physical silver, you're not reliant upon the bank. And that's, I think, the strategy that we have to use going forward from here, because of all of the problems that the global financial system faces, although the hot spot at the moment seems to be Europe.
The other ramification from Brexit that's of interest is how it's changed interest rate expectations on a forward basis, and the whole expectation for even the possibility of not seeing rates rise until 2008 is starting to be reflected by a minority opinion in the futures markets, which is pretty surprising. And the whole idea of a rate hike in 2016 is now unlikely as well. And as that percolates through the consciousness of the average financial participant in our grand Western financial world, what do you think that will do in terms of the whole precious metals backdrop for fundamentals?
Well, it's obviously going to be very bullish for the precious metals. I've been saying for years that the Federal Reserve is not going to raise interest rates for one very simple reason. The U.S. government cannot afford to pay a fair rate of interest, simply because it's got too much debt. It's got almost $20 trillion worth of debt. If you raise interest rates just 1%, that's $200 billion a year of extra interest expense that has to be paid. That means they have to borrow that extra $200 billion, raising the debt even more, and you then get into the hyperinflationary spiral where you're borrowing just to pay interest, and you ultimately destroy the currency. So, the Fed is there keeping interest rates at zero for that reason. And but they can't go on forever because the debt continues to accumulate even at zero interest rates. And we're reaching a stage which is totally ridiculous, where people are actually giving money to the government and expecting less back in 10 years because of negative interest rates, which is totally absurd. The last book that John Rubino and I did is The Money Bubble. And we have to recognize that the big bubble today is this money bubble. It's, what people today call as money is not really money. It's only a money substitute circulating in place of money, which is, of course, gold and silver. And as people start to understand the foolishness of what's going on with regard to what central bankers are doing, negative interest rates, the central, near bankruptcy of the big welfare states, it's inevitable that we're going to go back to basics. We're going to go back to reversion to the mean. And if you look throughout history, every time you've been in a bubble before, people move into move out of financial assets into tangible assets. And one of the tangible assets that does best in that kind of environment is the precious metals, both gold and silver. But again, I'm talking about physical gold and physical silver.
Yeah, let's talk a little bit more about that, James. I mean, we're recording today on June 30th. It's the last day of the first half of 2016. And gold's up 25% on the year. Silver's up, I think, 34 or 35% up on the year. The Hui's up almost 125% on the year. And we're only 6 months into the year. And that sounds astonishing, and it is. But if you take a look at, say, a 10-year chart on silver, you literally can't even see the move off the lows. It's even though percentage-wise the move has been so strong this year. Silver is at pretty critical resistance right here at about 1850. I think we could see a pretty exciting move if silver can clear this area here, 1850, 1860, and start to move to the upside. What's your take on more of the short term for gold and silver?
Yeah, I am so bullish on gold and silver here, particularly silver because it's cheap relative to gold. I say that because I follow the gold-silver ratio, how many ounces of silver it takes to buy 1 ounce of gold. And the way I see silver is, obviously there's some industrial components for silver and other factors that come in, but I really see it as a substitute for gold in the sense that if you have 1 ounce of gold or 72 ounces of silver, you essentially have the same amount of value outside the banking system. But historically, the ratio for gold to silver is much lower. For example, in April of 2011, when silver got back to that $50 per ounce level, the ratio was 31. So I expect the gold-silver ratio to fall for the foreseeable future, both in the short term, as it's been doing already this year, but continue to fall relative to gold, meaning that silver is outperforming. And a target of like 30 to 1, which we saw in April of 2011, is not an unreasonable target to have for silver in the next year or two ahead. So as gold goes to a new high above 1900, which I do expect to happen probably next year, but I don't rule it out this year if we have another big financial panic, silver is going to ultimately take out that 50 high, and that's when the bull market in silver actually begins. From 1980 to today, silver really hasn't been in a bull market. It's just been accumulating in a huge basing pattern. It's only going to go into a bull market when we take out the 1980 high, and silver is essentially the only commodity that's still trading below its 1980 high, or put it this way, it's the only commodity that since 1980 has not taken out its 1980 high. So when that happens, then you're going to see silver just, skyrocket, along with gold, which will be skyrocketing as well.
Have you seen an uptick this week and leading into the Brexit vote from your customers at Gold Money looking to hedge against the possible turmoil from Brexit?
Yeah, the business has been very good, not just from the UK, but globally. Simply because of all of the uncertainty that's being created, not just by the Brexit vote, but by what's happening to the stock markets, what's happening to currency movements, volatility. So yes, it's been very good, and which is a little bit unusual because the summer things start to slow down. But every once in a while you get a summer where things actually heat up, and this could be one of those summers.
Well, we were talking about negative interest rates a moment ago, and it was reported today that now we are at $11.7 trillion worth of negative interest rate sovereign debt worldwide. And I think that's double this year at the rate that we're seeing rates slide into negative territory. That alone seems to be something that can awaken a lot of the sleeping conventional financial world to just the obvious attractiveness of the precious metal space. Well, it'll be interesting to see how many of the more higher profile individuals come to the table that has been getting the attention of the Soroses and others around the world.
Yeah, there have been a lot of hedge fund managers that have made major pronouncements earlier this year that they've been moving into metals, and I think that they're obviously being proven right.
Well, it's interesting too, because we have seen a little bit of a slowdown in China's purchases and an uptick in Western purchases, particularly ETF gold. And I know that you follow that pretty closely, and I was wondering if you could give us some of our listeners a sense of where you're seeing just flows from an institutional point of view, and what is your take as far as Canadian and American and European perspectives from an institutional point of view when it comes to accumulating gold?
They're only just scratching the surface. Even with the big hedge funds that have made these announcements, people are still just looking at it and don't really understand, the precious metals, which I think is really the big problem that the precious metals face. Not everybody, the majority of people still see gold and silver as speculative commodities rather than what they are, which is money. I always like to use the example that an ounce of gold still buys the same amount of crude oil it did 50 years ago. So when you calculate the price of goods and services in terms of gold, or calculate the price of goods and services in terms of silver, you get an entirely different picture than when you calculate those same goods and services in terms of some fiat currency. Because what's happening is fiat currencies are losing purchasing power that's being eroded. Even in this environment, purchasing power is losing, national currencies are losing purchasing power because there's still inflation. And you have central banks saying that they're trying to create more inflation to destroy even more rapidly the purchasing power of national currencies. What's likely to happen as we move toward the end of the year, last year we're going to see more inflation. Last year we got a big benefit in terms of commodity prices falling considerably. Oil went all the way down to $28 a barrel. But right now, oil is $48 a barrel. It's gone up 80% so far this year. That's going to have a huge inflationary impact. Now, given the fact that the inflation of the inflation of services, labor costs and things like that, they never deflated. They continue to inflate. Medical expenses, they continue to inflate. Educational expenses, they continue to inflate. Now you add rising commodity prices on top of that, you're going to see much higher inflation as we go toward the end of the year. But the scary thing is that the economy is slowing down, which is what happened in the 1970s. You end up with stagflation, a stagnating economy and rising prices. And that's the worst of all possible worlds, but that's clearly where we're headed.
Yeah. Even the velocity of money is continuing to slide down and down. There's just it's kind of like a depressionary attitude with monetary stimulation leading to stagflation.
Yeah, but I look at velocity slightly differently than the way most people do. The reason why velocity is declining is because there's too much money being pumped into the system relative to the economic activity. Understand my point?
That's a good point.
And basically what I'm saying is that because there's too much money being pumped into the system relative to economic activity, that money is already and going to continue to result in higher prices and more inflation. In fact, I think it's 7 months in a row now that inflation, even by the government's own reported statistic, is and the one that the Federal Reserve talks about, its 2% inflation target. It's above that at 7 months, at or above that for 7 months in a row. So why isn't the federal government raising interest rates to begin controlling inflation? It's because the U.S. government can't afford to pay a high interest rate. So, what we're at is, I think we're very, very close to a 2008 type situation, but it's not going to be one that central banks are going to be able to dig themselves out of. And I think it's going to be something that's going to be more cataclysmic. Back in 2009, when the Greece crisis started appearing, I wrote an article saying, questioning whether the Greek crisis might cause the end of socialism in terms of socialistic thinking and the way governments run the welfare states. And everything that's happened since then suggests that more and more people are starting to understand that the socialistic policies of the welfare states cannot be sustained because there's not enough wealth being created to service the debt or to keep governments from becoming insolvent. And I think that's the issue we're going to face next time around. It's not going to be a bank goes under. It's going to be some government goes under, and what the implications of that are going to be are going to be totally mind-boggling, and which makes it even more important that you own physical assets, minimize your financial assets. And when it comes to physical assets, as far as money is concerned, of course, that means physical gold and physical silver.
Now, James, I want to ask you more long-term outlook a question. You were talking a moments ago about the gold-silver ratio and that you could see in the next year or two it could reach 30-1, and I'd agree with that. More of a long-term outlook, and as we were also talking about that the real bull market only begins when silver takes out that $50 high. If we're looking down the road and we're looking at the ultimate final blow-off top in what's been about a 15-year bull market in precious metals, some of the numbers I look at, as you talked about, the historical ratio has been closer to 16-1 for gold to silver. The actual mining output coming out of the ground right now is closer to 8 or 9-1. And historically, when we see a blow-off run-off top, I would expect that ratio to overshoot. I think it'd be possible in the final blow-off top of the gold and silver bull market that you could see a 5-1 ratio. Do you think that's unreasonable? Or do you think that's a possible ratio in a final blow-off top, rhino horn type top of the final move in the bull market?
Yeah, well, I'm pretty confident that it's going to go below 20-1. I would say that's probably 90% level of confidence. Whether we get down to 10-1 or 5-1, my level of confidence would be decreasing quite considerably. But anybody who owns silver, if we get to even 20-1, is going to be doing very, very well. But I do agree that it is possible that in a final blow-off, that could happen. But I want to make 2 points. First of all, you said about the bull market. It's been a 100-year bull market in the precious metals. Back in 1913, when the Federal Reserve was created, 1 ounce of gold was $20.67 per ounce. It's been basically a one-way street. Obviously, there are fluctuations, but it's been a constant debasement of the dollar. And I think we have to put it in terms of the long-term context. And secondly, with regard to the blow-off, back in 1980, when the blow-off occurred then, I kept saying to myself, this is not going to be the end of the monetary system. There'll be another event later on at some point in time in the future. I didn't think it was going to take this long, to be quite honest, but I think we're still heading in that direction. And it will be not like a 1980 blow-off where you sold your precious metals and went back into dollars. It's going to be a new type of blow-off where you actually spend the gold and silver that you're accumulating now, because dollars and all other national currencies will be totally discredited. So you're going to know when the blow-off occurs, because it's going to be, people will want to accept your gold and silver for goods and services, not for dollars.
That might even change the entire nature of the last 10% of any bull market move in a blow-off top. You might not even have it if we have new currency regimes and everything being replaced. We might never get that 5-1 ratio, Doc, because by the time we hit 15 and we have the beginnings of the blow-off top, who knows? Maybe rational thinking policy will begin to try to address our monetary system at the same time, and it'll be like what James posits, where on the other side of whatever kind of transition that people are insuring themselves against by their acquiring of precious metals holdings.
That's a very good point. And it goes to the very basic premise that we cannot predict the future. So
Exactly.
how do we prepare for the future? What we do is we accumulate undervalued useful assets and get rid of overvalued assets. And right now, one of the most undervalued useful assets in my mind are physical gold and physical silver.
Yep, very good point. Anything else that you'd like to chime in on, James, or Doc, question about?
On a short-term basis, I'm very encouraged that we're up here at 1850. We're almost broken out from this long-term basing pattern. My gut feeling is that maybe we have one more retracement back to 18 before we break out. But regardless, the upside potential is far more significant than any downside risk you have from here. And that's just from a trading point of view. From a long-term point of view, which has been my recommendation, since I started Gold Money back in 2001. Just, every month, whenever your family budget allows it, plan for it. Just dollar cost average, continue to accumulate physical gold and physical silver, because when these monetary events are finally over, you're going to be very, very happy that you protected yourself and your family with those precious metals that you're accumulating at these prices. You're saving money, and even better than that, you're saving sound money.
And I think a lot of times people lose track of that just in the day-to-day of all the mope across the media and watching gold and silver prices go down over the past 4 or 5 years, that ultimately, number one, they're financial insurance and protecting your wealth. They're not a Vegas bet that you're going all in hoping to strike it rich on gold and silver. Now, I think it's quite possible that you could gain, and likely will, because as we've been talking, they are so undervalued. But number one, their insurance and wealth preservation means.
Yeah, absolutely. They protect purchasing power over long periods of time, and they do it because you have money, because of the history of gold and silver in terms of the way they're accumulated, but also they're giving you money outside the banking system, which this moment in time and going forward for the foreseeable future is, in my mind, something that's very important.
Before we let you go, I'd love to ask you a question about what your perspectives are when it comes to the future of money itself, and how central bankers are beginning to flirt with the blockchain technology, and you have a tremendous experience when it comes to understanding gold and its relation to possible payment systems, and your work in this area with Bitcoin and gold money. What do you think? Where do you think the powers that be are going? How are they going to wrangle blockchain technology, and where do you see their strategizing, and where possibly even Bitcoin or other technologies could fit into that kind of a paradigm as it evolves in the future?
There's a saying that Winston Churchill had when he was talking about Americans. This goes back during the Second World War, that they'll do the right thing, but only after doing all of the wrong things first. So in other words, they're going to experiment with a lot of different things, fiat currency, blockchains, and whatnot, before they eventually go back to gold and silver. Now, that doesn't mean to say that the blockchain doesn't have a role to play. I think it does. It's a very important technological development in my mind, and I've been making that point for quite some time. And I think people will continue to move into cryptocurrencies as an alternative to national currencies. But at the end of the day, governments will either they're going to come back into the precious metals, and they'll either do it in a logical way with a 5-year plan as to how they return the currency to a gold backing, or they're going to do it kicking and screaming, and the market will drive them back to it. And only time will tell, because it's really going to depend on the decisions of politicians and central bankers in the future as to what they choose to do. But yeah, blockchain is interesting, but at the end of the day, gold's got a 5,000 and gold and silver have 5,000-year histories as money, and I think that means a lot.
All right, James, it's great to have you back with us. Thanks for joining us again.
It's always great to be with you, John and Eric, and let's do it again in the future, because I think this is going to be a pretty exciting year for the precious metals.
We'll look forward to it. All right, for James Turk of BitGold and GoldMoney.com, this is the Doc and Eric Dubin. Thanks for tuning into this week's SD Weekly Metals and Markets.